Economic risk. Economic risk refers to uncertainty caused by changes in the economy, which can affect investments, businesses, or overall financial health. Shifts in economic growth, unemployment, or inflation can disrupt markets. For example, during a recession, reduced consumer demand can lower company profits, which negatively impacts stock performance. High inflation erodes the real value of investments, meaning returns must outpace inflation for true gains. Asset liquidity risk. This type of risk occurs when an asset cannot easily be sold or converted into cash without a significant price reduction. For instance, real estate is often considered illiquid because it can take time to sell, and doing so in a rush could require a price cut. Legal risk. Legal risk arises from the possibility of financial loss due to legal actions, fines, or non-compliance with regulations. Companies that fail to meet regulatory standards, breach contracts, or face lawsuits may incur heavy penalties. Political risk. Political risk stems from changes in government policies or political events that affect financial markets and investments. Factors like political instability, new laws, or government interventions can disrupt markets. For instance, an unstable government might nationalize assets, causing foreign investors to lose money. Directional risk. It refers to the risk that the value of an investment depends on the direction of market movement. If the market moves opposite to their expectations, they face losses. For example, a trader who expects a stock to increase in value but sees it drop is exposed to directional risk. Managing this risk involves using strategies like stop-loss orders or diversifying positions. Sovereign risk. Sovereign risk involves the risk that a country might default on its debt or fail to meet its obligations. This type of risk is especially important when investing in government bonds or doing business in foreign countries. If a country is unstable or mismanages its economy, it may be unable or unwilling to repay its debt. Sovereign risk is commonly measured through ratings issued by agencies like Standard & Poor's or Moody's. Fraud risk. Fraud risk is the potential for financial loss due to fraudulent activities, such as embezzlement, misrepresentation, or accounting manipulation. Fraud can occur at any level of an organization, from employees stealing funds to executives manipulating financial statements to inflate profits. High-profile examples like Enron show how fraud can devastate shareholders and employees. Preventing fraud risk involves establishing strong internal controls, regular audits, and a culture of accountability. Funding liquidity risk. Funding liquidity risk refers to the risk that a company may not be able to meet its short-term obligations because it cannot convert assets into cash quickly enough. This became a major issue during the 2008 financial crisis, where many banks faced sudden liquidity shortages despite holding long-term valuable assets. Funding liquidity risk is managed by maintaining adequate cash reserves, securing lines of credit, and ensuring assets can be liquidated if necessary to meet obligations. Interest rate risk. Interest rate risk is the potential for financial losses due to changes in interest rates. This is particularly significant for bondholders since bond prices move inversely to interest rates. When rates rise, the value of existing bonds falls because new bonds offer higher yields. Non-directional risk. Non-directional risk applies to investment strategies that do not depend on market direction. Hedge funds often employ non-directional strategies, such as arbitrage or market-neutral positions, which aim to generate profit regardless of whether markets go up or down. While these strategies reduce exposure to market risk, they introduce other risks, like liquidity or operational risks. Credit event risk. Credit event risk arises when a borrower defaults on debt or experiences a major credit event, like bankruptcy. Credit default swaps, CDS, are commonly used to hedge against credit event risk, offering protection against a borrower's default. Credit event risk is most pronounced in high-yield or junk bonds, where the risk of default is higher, but so are potential returns. People risk. People risk or human risk refers to the potential for loss due to errors, misconduct, or negligence by individuals within an organization. This can include everything from poor management decisions to fraudulent behavior by employees. For instance, a rogue trader making unauthorized transactions could expose a company to significant financial losses. Managing people's risk involves creating strong governance frameworks, fostering a culture of ethics and accountability, and implementing comprehensive internal controls. Volatility risk. Volatility risk is the uncertainty or rapid fluctuation in an asset's price. High volatility assets can experience wide price swings, creating opportunities for large gains or losses. For example, tech stocks or cryptocurrencies tend to be more volatile compared to traditional bonds. Managing volatility risk often involves diversifying portfolios, using stop-loss mechanisms, or investing in assets that hedge against sharp market movements. Currency risk. Currency risk arises from exposure to fluctuations in foreign exchange rates. This risk is particularly relevant for businesses and investors who deal in multiple currencies. For example, a U.S. company with significant revenue from Europe may see profits shrink if the euro depreciates against the dollar. Settlement risk. Settlement risk occurs when one party in a transaction fails to deliver the required payment or asset after the other party has fulfilled their obligations. This risk is prevalent in international transactions, where time zone differences or regulatory issues can delay settlements. Settlement risk is particularly high in currency trading, where large sums are exchanged, and a failure to deliver on time could result in significant losses. Model risk. Model risk arises when financial models used for decision-making are flawed, leading to inaccurate predictions or poor outcomes. Models are essential for pricing assets, managing risk, and forecasting market trends, but incorrect assumptions or data can result in substantial losses. During the 2008 financial crisis, many models underestimated the risk of mortgage-backed securities, contributing to the market collapse. Relative risk. It is comparing the risk between two investments or strategies. For example, stocks are generally riskier but potentially more rewarding than bonds. By comparing relative risk, investors can make informed decisions about portfolio diversification and balancing risk with potential returns. Basis risk. Basis risk happens when the price of something you own and the price of its protection move differently. For example, if a farmer uses a wheat futures contract to protect against changes in wheat prices, but the current market price and the futures price don't move together. Inflation risk. Inflation risk is the danger that rising prices will erode the purchasing power of money and reduce the real returns on investments. Inflation risk is particularly concerning long-term fixed-income investments, where returns are fixed but inflation can fluctuate. Strategic risk. Strategic risk involves long-term threats to a company's business model or strategic direction. This can result from technological changes, shifts in consumer behavior, or new competitors. For example, the rise of digital media has created strategic risk for traditional print media companies. Absolute risk. Absolute risk is the total risk in an investment or situation, without any protections in place. It shows the maximum possible loss. For example, if an investor puts all their money into one risky business and that business fails, they lose everything. Absolute risk is important to think about when making risky investments or decisions where there's no backup plan. Third-party risk. Third-party risk arises when a company relies on external vendors, suppliers, or partners. If a critical third party fails to deliver goods or services, it can disrupt operations and lead to financial losses. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more financial tips and insights.